Congratulations, you made it to episode 100 of the FIFE Movement. I'm so glad that you're here, whether you've listened to all episodes so far or you're joining us for the first time. Welcome. I'm Amanda Neely. I'm your host, and this is the only podcast that helps you create your unique feminine and entrepreneurial path to financial independence. Now, there's a very common concept that I talk about on this uh, channel um, that there's a big objection that when people like dig into it, it's one of their first things. They're like, "Oh, I'm not doing that because." And I hear it over and over again. And I thought for episode 100, what better way to celebrate than to take on the biggest objection that I hear a lot about bank on yourself slash infinite banking slash dividend paying, high cash value, whole life insurance, whatever you want to call it. So I'm going to share my screen and do my best attempt to explain why personally I chose to do this concept despite the number one objection that a lot of people have. And you can decide for yourself if that's convincing to you, if that makes sense to you. And then, of course, reach out to a bank on yourself professional to get the same kind of numbers for yourself. So here we go. Let me share my screen. Make sure I get the right screen. Here we go. So this is a YouTube example, but this is really me. Like I'll just put Amanda Neely because I prepared this for myself. And I'm going back, I don't know, 7 years from when I started. I started when I was 29. And of course, at the end of the first year, I'm 30. And I started my first policy with $400 per month. This is the numbers that were pretty much shown to me, except I added a little bit here in year 6. I had a little bit of extra cash that I could put into my policy, so I bumped up that year. But otherwise, everything is the same. Now, what the biggest objection most people have is this what's called loss of liquidity or cost of insurance in these first several years. When you look at the amount that you're putting in, your premiums paid, and then you look at the cash value, the difference between those, right? I'm taking the one and subtracting the other. The difference between those is a big deal for people, particularly if you're like, this is cumulatively, by year 3, that's when I hit the highest amount of cost of insurance or loss of liquidity. It's taking my cash value at year 3 and subtracting the premiums that I've paid so far. And a lot of people um, say to me, and I thought this myself back 7 years ago or so, um, like there's so much I could do with that $4,000 at that point, or the 1,800 in the first year, or the 3,000 the next year, right? Or 4,000 total that I'm giving up in order to do this policy. Um, Short term wise, and we can get stuck there in that short term thinking. But I kind of call it rule number 1 of using the bank on yourself concept is to think long range. And that's hard to do. I want to talk about that more on this channel. As humans, like we're animals, there's kind of this survival thing. We need to be thinking short term, right, in terms of making sure we're surviving. But it's not really like natural for us to think long term, and that's a muscle that we build. I'll just put that out there and we can come back and talk about that philosophically later. But what's fun is when you look at the long-term effects of the choices that you make, it can help you make better choices. So you're not just thinking short term, but you're also thinking long term and weighing the pros and cons of both the short term and the long term, right? So most people, though, get stuck right here. I want to show you what you'll notice is that it switches to a gain and continues to gain throughout. Kind of the loss of liquidity or the cost of insurance are um, they don't the costs don't really go away, but they're outweighed by the gains within the policy. Um, and then this is an example that if you didn't catch a live that we did on Friday, January 29th with our friend Sari, we use this example with loans. And so I'm just adding on to that example. So check out that episode for that. But to really appreciate this, right? I love this gain, right? The total kind of loss in the first 9 years in terms of loss of liquidity, right? Remember, you only at most lost 148, or I did. But if I add up all those years, right, that's 21,000. I didn't really lose 21,000. But in terms of that loss of access, right, 21,000. But I made 51,000 even when I factor in the loans that are there. No, sorry, 51,000 before factoring in loans, and then it's 40 some thousand after. Now I want to look at the comparison to an alternative. So what I did here was I took the same exact contributions. There's a little bit of rounding errors here, but I try to get it as close as possible. And then I just gave it a very generous 5% growth every single year. Now, if you know an account that'll give you access to your money and give you 5% growth every year, please let me know. I want to know about it. Most savings accounts, CDs, they're much, much lower than that right now. But if you know of something, please let me know. But for to be, give the benefit of the doubt to this alternative without loss of liquidity, I thought I would kind of show this. And so I use the same numbers. I did the same instead of loans, you do withdrawals because you can't do loans against most alternatives out there. Again, if you know of one, please let me know. And the biggest thing about this alternative with loss of liquidity is that all of them that I'm aware of, you have to pay taxes every year. You get a 1099 from the bank or whoever you have your money with, and you have to file the growth on your taxes and pay the taxes due. Now, the one thing I didn't do here because it would just been too much work is take those taxes out of the balance. I have the taxes actually just being paid from somewhere else so that your balance continues to grow, except for these two withdrawals. Okay. And what I found when I took this out the long term is that, like, if you just look at the balance, even especially at the end, if you've put the same exact dollars in, right? Let me look here. So total contribution, let's go to age 57. Total contributions 165, cash value, the value of your account, 311,000. So your difference, you made 146. If we scroll back over to this one, you're actually only at 104,000, which is a lot less. But in this scenario, we didn't factor in the taxes. When I factor in the taxes, we're at 112,000 instead of 104,000. But that's still more. You're saying, Amanda, why would you do whole life and not this alternative? But you'll notice that the contribution's 143. Over here, it's 165 because I told you there's some rounding errors. So my real rate of return when I calculate that is 2.44 over here, and it's 2.6 over here. So what I did there for you math nerds that want to know this, I took so this is the difference in the cash value to the contributions. This is the difference divided by the contributions, and then this is divided by 28 years. That's how long I took it out here. So when you factor in taxes, my 3.16% return turned into a 2.44. But because the whole life example over here, no taxes are due, I actually get to keep all of my gains then. I don't have to pay taxes on those gains, at least under current law and how this policy is structured and how I'm using it. So that can be a pretty big deal, right? 0.16 might not feel like a big deal, but the more that you're accessing it, the more you're using it, the more that difference comes in. Plus, there's some things I did not factor in. Of course, the options, where can you get 5% without losing liquidity? The risk, right? Can you really get 5% every year? If you're using a savings account, the bank can change your interest rate anytime. If you're using a CD, when you buy that CD, it's at the bank's then rates. If you're using a money market account, right? If you're using stocks, those go up and down. So you've got to factor that in. Also, dividends are at historic lows right now. So when you see those numbers on the whole life side, the the dividends are at the current rate and at that same rate every single year going forward. But dividends are at the lowest they've been in a long time. What do you think is going to happen in the future with dividends? It's something to think about with the whole life side. And then fees. I didn't factor in any fees in the alternative. Um, Maybe if you're using a savings account, there's no bank fees, but there could be fees if you're using something else, or you're asking someone else to manage your money. So be sure you factor that in, not just taxes and the growth, right? And then, of course, with the whole life, I do get the death benefit and the accelerated death benefits that will protect me if I get some kind of chronic or terminal illness, and it will protect my family if something happens to me to replace the income that I could be earning and to take care of them throughout the time. Plus, I only took this out to age 57. When you work with a bank and yourself professional, they're typically taking it out to 95 years. That's what mine did for me back in the day. That's what I do for others now, to age 95. Sorry. So you might want to even think longer term. There's this common saying that we use. I don't know who said it first. If you know, please put it in the comments. That poor people think for Saturday night, rich people think for 3 generations. So I only took this 28 years, but what if you took it 128 years, right? What is the difference that it's going to make, not just for you, but for the future generations? Or maybe just for you, if maybe we live longer lives, this can make an even bigger impact for ourselves. That uninterrupted compound growth thing. So that's my take on, I mean, would you give up $4,000 to have a 0.16% bigger rate of return over um, 28 years? Maybe not, right? That can be hard. But when you factor in all these other things that are not tangible, they're kind of off the spreadsheet, right? Because you can do a lot with spreadsheets, but you can't do everything. And there's a lot of factors to weigh in, and you have to look at that. Um, and then also, right, what are you going to spend that $4,000 on? Let's just say, you know, most people are maybe just going to spend it, not even know where it went. But when they can be disciplined and, go after something like this. But also, let's take this to a 10 scale. Maybe you're putting in $48,000 per year. Um, that then maybe this is $40,000. In terms of like loss of liquidity. Um, what would you do with that 40,000? Maybe it's a real estate investment. Could um, Do you really need that if you're going to have 100,000 over here? That's something to think about too. In terms of how many deals are available, what can you get going with them? So I know this hasn't been as like cut and dry in terms of like easy answer, but really important decisions like where to put your money to see it grow for you and be there for you is a really important thing to be thinking about. And part of why I'm making sure that I'm creating episodes about this kind of thing, and part of why you want to work with a professional who will do these kinds of analysis with you. And maybe it's still high level, like whiteboard kind of thing, but also if you like to get into the details, will help you think through the Excel sheets and the other options that you have and things like that too. Um, so hope this has been helpful. Kind of one of the things that I hear a lot is that people don't want to lose that initial cost, and they're thinking the 7 years versus thinking longer term. Um, and especially they're not really making that side by side comparison with what what they could do through the bank on yourself concept and what they could do somewhere else. And you really have to see that side by side in a fair way, right? Don't put in 5% if you don't know a 5% thing, right? Only put in 1%, and then you'll see the difference be even bigger longer term. Right. If that's what you're getting in your savings account right now, or 0.1%, if that's what most people are seeing. Um, so yeah, that's kind of my take on it. The number one objection is often that loss of liquidity. And my biggest thing is you got to think long range and ask if that's worth it, especially if you think you're going to do a policy like this at some point in your life. When is the best time in your life to have that loss of liquidity? When I most people, when I ask that, say, "Well, as soon as possible, so I get it over with," right? Kind of like ripping off a Band-Aid, but that's for you to decide too. So, I know this hasn't been, like, all salesy, like, "Bank on yourself is the best thing ever," but I wanna be real with you and share with you what, the real numbers kinda look like and what you might think through. Let me know what you think. What else would you like to see? We've got another 100 episodes to make plus, and so I'm looking forward to your input. What would you like to see, how things work, and the behind the scenes there, as unbiased as possible. Okay, thanks so much for being here, for joining with the FIFE movement. As you go about your day today, remember, wealth is coming your way. Your quest is to prepare for using it well. I want to invite you again to connect with the movement at fifemovement.com. I've got a gift there for you that I'd love for you to have. And if this episode has been helpful to you, please pay the gift forward and share this episode with a friend.